Hello, and welcome to the Fin Know-How Foundation course video on financial decision making. As you can imagine, financial decision making is intrinsic to most business decision making. And what we are going to be talking about in this video is about the various criteria that can be used, theoretically sound criteria that can be used to make those decisions. The ability to make those decisions. And by the way, financial decision making is also sometimes known as capital budgeting because it deals with how you allocate a budget, the capital, in a way that can generate a rate of return higher than your opportunity cost of your capital. Okay. Specifically, we'll be dealing with certain techniques such as the net present value and the internal rate of return, but the details of that we will get to in a moment. So the challenge that businesses and managers face and business leaders face when they have to make business decisions is that often, or in fact, most of the time, you do not have certainty about the outcome of those investments. So for instance, if you were to buy a share of stock, you may like the stock, you may like and you may hope that the stock would appreciate, let's say 15% in value. But in reality, it may not appreciate at all, or may even decline in value, or it may appreciate only 5%, or it may appreciate greater than 15%. You have no way of knowing how exactly it's going to play out when you're making the decision. So you're making decisions under what's called uncertain circumstances. And that's what makes financial decision making complicated. And these kinds of decisions show up in very many ways. You might be, for instance, you have a lab, you want to add new laboratory equipment, or your manufacturing facility, you're considering adding a machine. The financial decision-making criteria will help you decide if that decision, let's say you add a machine that or a lab equipment that reduces your costs. That cost reduction will generate increased profits and will generate a rate of return. And you want to be able to benchmark that increased rate of return from that investment against the opportunity cost of capital that went into acquiring that equipment. So that's kind of the logic that's built into capital budgeting decisions, or you could even more simply say it's a cost benefit analysis. What is it that you're benefiting from when you make an investment? And you're making this decision when you don't know for sure what the benefits would be, but you have an expectation of those benefits. And the question really is are those benefits high enough to exceed the opportunity cost of the capital that went into the investment? So we will see how this works through a few examples. Specifically, we will talk a little bit about the purpose and the role of these criteria. These criteria, for example, cover methods like net present value, internal rate of return, payback method, and so on. We will apply those methods to assess the financial viability with some examples of certain investments. We'll recognize the trade-offs between the different methods, which method to employ when, and what are the trade-offs in choosing one over the other, and then talk a little bit about combining these criteria to make sound business decisions. The theoretically most sound method for financial decision making is called net present value, or more commonly, net present value as in NPV. Again, as I was saying earlier, it's a cost benefit analysis where you're looking at the benefits net of the cost, hence the word net. Now, as you may remember from our time value of money discussions, all allocations of capital involves time. You make an investment today to get a return in the future. There is a time lag. So time value of money is embedded deeply within these decision-making criteria. So really the question here is that what is the incremental benefit? That is the benefit in excess of the cost once you adjust for the time value of money. And if that benefit exceeds cost after accounting for the opportunity cost of capital, in net present value terms, we would say that you have what's called a positive NPV, meaning that the benefit exceeds the cost. If your NPV calculation shows that the benefits do not exceed the cost, the NPV is said to be negative. So in effect, that investment would destroy value. The higher the NPV, meaning the higher the amount by which the benefits exceed the cost, the more attractive the investment. So when you think about it, NPV is evaluated in dollar terms. How many dollars of benefits did you get in excess of the dollars of investment that went into the business? So let's look at an example. You are acquiring a software with the upfront cost of $350,000. And this upfront cost generates $100,000 in cost savings, or that means $100,000 in additional profits every year for 5 years, because that software helps automate workflows. So as in the example below, we could, as in the examples that we worked out in the last video, we could calculate the present value of the investment. The investment is an upfront investment, so the present value of the investment is $350,000. No adjustment needed for time value of money. But the $100,000 that you receive, 5 payments over 5 years, reminds you of an annuity. So it's the present value of an annuity with a discount rate of 10%. And we're going to compare the present value of the annuity of 100,000 over 5 years relative to the upfront cost of $350,000 and see what the difference is, and that becomes the basis for the NPV calculation. So as in the previous examples, as it relates to time value of money, I'm going to do the math here using Copilot so that you can see how it plays out and you know how to use it. Going to do the math here, and we'll see, you can see both the logic and the result. The benefit, as this calculation happens, I want to point you to a couple of things. One of the benefits or the key strengths of the net present value method is that it's theoretically sound. It accounts for the time value of money because you're computing present values. You can measure the direct dollar benefit. And by the way, the term value creation, you might hear in all kinds of documents the reference to, hey, this was a value creating investment or a value enhancing investment. Without say using the words, what they're essentially saying is that that investment generates a positive NPV. The benefits of that investment exceeds the cost, so it creates value. So just remember that when you talk about value creation, you're really talking about the net present value being positive. As you can imagine, if the NPV is positive, then you would want to take on that project. If it is negative, you would not. And let's say you have a limited amount of dollars and you have to choose between 2 projects. Of course, you would pick the project with a higher NPV. What are the limitations of the NPV method? It is, you have to be able to get the discount rate calculation right, because you have to know exactly what the opportunity cost of a capital is. Also remember that you are working with uncertain cash flows. You have to come up with projections, and you don't know always that the projections are right. So the reliability of the projections, the believability of those projections will drive the believability of the NPV analysis. And sometimes, in my experience, I have seen that NPV results are hard to interpret for folks who did not come from a finance background. So let's say you have two projects, one which says I've got an NPV of positive $1 million, the other says I've got an NPV of positive $1.2 million. If you understand the cost benefit nature of the discussion, it's easy to understand that the first case you added your net benefits over $1 million in excess of the cost in present value terms. And the second project gives you 1.2 million in excess of the cost. But in the real world, I have often found that folks who do not come from a finance background often have some difficulty understanding the nuances of an NPV calculation. So while we were discussing that, it turns out that the calculations were performed by ChatGPT, and it came back with exactly the number that was presented on the page of 29,000 29,000 roughly, yes, so $29,078.68 rounded off to approximately $29,000. It's positive. It's positive here as well. And so if you wanted to see the details behind the calculation, for instance, you can say, show me the detail behind the NPV conclusion. You can now see it's looking at the benefits less the costs, and you can see the step-by-step calculation and all the details here as well. Okay, so again, so long as you understand that NPV is a cost-benefit analysis, and that cost-benefit analysis is done in present value terms, as the name suggests, it's present value, but it's a net present value. The present value of the benefits net of the present value of the cost. And that's what the concept behind NPV. And now you can also see how that calculation can be done using a chatbot. Now we're going to switch to the second method that's often used in capital budgeting or financial decision making, which is the internal rate of return. Okay. So if you will go back to the NPV analysis, what we were doing in the NPV analysis is that you have the benefits, you have the cost, and you have the cost of the discount rate that you use, and that's how you do the NPV calculation. What if you wanted to not use the discount rate, but you wanted to figure out that based on the investment you made and the payoffs you get, what is the implied rate of return, or what is the rate of return implied by that investment? Okay, so another way of thinking about it, let me pull up the Excel spreadsheet and you will see the calculation in a moment. So I'm going to use an example of an investment which requires an upfront investment of $250,000, generates a rate of return, generates $60,000, growing at roughly 3% a year over 5 years. Okay. So if I present it in a table, in year 0, I have a cash outflow of $250,000, which I denote, since it's an outflow, I'm denoting with a negative sign. Everything else is an inflow or a benefit, so I've got positive signs. I do the present values of each of those cash flows. At a 10% rate of return, the present value of each of these cash flows, a factor that I'm going to multiply the cash flow by is 1.9, 0.86, and so on. As you can see, as I push out in time, by the time I get to the 5th year, I discount the value by roughly 38%. In other words, the present value of the $67,531 is only $41,931. So if I add all of these numbers up, I get $240,156 in benefits. My upfront investment is $250,000. So that means at a discount rate of 10%, my NPV is negative 9,844. If I think about the interpretation, this means my benefits in present value terms do not exceed my investments. So this is a bad investment to make. Now let's reframe the question and say, hey, if it was 10%, I can't make the investment. But at what rate will I be okay with this investment? And one way to think about it is in break-even terms. So at what rate will the NPV become zero? It's not positive, it's not negative, but at what rate will what rate of return will the NPV become zero? So I run through the same calculations here and I plug in various discount rates, and it turns out that at 8.48%, the rate of return, so this project generates, no, rather, rephrase that. At 8.48%, this project generates a net present value of zero. In other words, 8.48% is the break-even rate of return for this investment. Okay? This break-even rate of return is called the internal rate of return. And the intuition still makes sense because I require a discount rate of 10%. But the project yields only 8.48%. So it does not deliver the 10% I want. So I will reject this project just as I did, but using a different calculation in the net present value table above. Right? So just to be clear, both NPV and the internal rate of return calculations use the same logic. It computes the cost and benefit on a present value basis. The only difference is that in the NPV calculation, you're focused on coming up with the dollar value by which the benefits may exceed the cost. If the benefits exceed the cost in present value terms, you have a positive NPV, you consider the project to be a good one. If it is benefits are less than the upfront investment, then you get a negative NPV, as in the example we have on the screen, and the net present value is negative, so we do not consider this a good project. Now, in the case of IRR, we take the same logic, but instead of solving for the NPV, we set the NPV to zero and then solve for the rate of return, which makes that NPV zero. And so in this example, the same set of cash flows, same outflows, same inflows. When we set the NPV to zero, the rate of return that is implied by NPV of zero for these set of facts is 8.48%. And logically, it makes sense because the 8.48% internal rate of return suggests that the project generates only a rate of return that is about 1.5% lower than what I would have expected from this investment, my opportunity cost of capital, my discount rate of 10%. Okay, so then the natural question that comes up is, how did I come up with this 8.48%? How did I get there? So the easiest way for me to do this is I can, like in the present examples, I can take these cash flows and I'm going to put it into ChatGPT and say, please compute the IRR and NPV for the following set of cash flows. Okay. So all I've done is I pasted these values here, exactly what I have on the table there, and I hit enter. Copilot does the calculation for me, does the analysis. And comes back with exactly the numbers I've had before here. And there are, of course, manual ways of doing this calculation, but given that the focus of this course is about making sure you understand the conceptual framework to deploy, but to do so in a way where you don't get lost in the details of the calculation, the chatbot-based approach makes sense. And like before, if you want to use our logic of uh, looking at the actual data to verify internal consistency, we see that the NPV is negative, so it's a project not to be accepted. And we see that the internal rate of return consistent with an negative NPV is lower than our required rate of return or the discount rate of 10%. So hopefully this calculation is clear. I am now going to go back to the slides here. I'm going to, okay. And here is an example that perhaps you can try on your own. So you have a project which is $500,000, requires an investment of $500,000, which yields cash flows of $150,000, $200,000, and then $300,000 over the next 4 years. And the question is, what is the IRR? So again, IRR is the break-even rate of return, the rate of return that causes NPV to become zero. The decision rule in the case of NPV was positive NPV, then you find the project good. If it is negative NPV, you do not. In the case of IRR, the decision rule is that if the IRR is greater than the required rate of return or the discount rate, or what is often referred to as even a hurdle rate, if the project IRR exceeds that, then it's a project that is attractive, so you would accept. And if the IRR falls below what you would require, your opportunity cost of capital, then you do not accept the project. In fact, you reject the project. Now, one of the advantages of IRR is, like, most people like talking about percentages and returns. And so it's very easy to explain. You can say that a project yields X% return. Most people will have a sense of what that means. And if you can say that it yields a rate of return greater than our required rate or our hurdle rate, that too is easy to understand. The only thing that you have to think about is that for certain types of cash flows, where you have, let's say, an upfront investment, but also a later investment and multiple investments along the way, where it's not as clean as in the examples that we just saw, where all the costs are front loaded and the benefits are coming over time. Rather, if the costs are also start to occur over a period of time, and there are positive and negative cash flows over the time horizon of the investment, sometimes you can get results which are quirky. And in those cases, the conclusions that you draw from the analysis may conflict with the NPV method. But as I said earlier, NPV is the gold standard because it's theoretically the most sound method. You are not forcing the NPV to be, you're not constraining the calculation in any way. Unlike in the case of IRR, where you're forcing the NPV to be zero and then solving for the internal rate of return. So you can have certain circumstances where the IRR calculation can be a little bit haywire, can go a little bit haywire, but it has its value, and especially if the cash flows are all outflows are all front-loaded and the inflows are all over a period of time in the future, then IRR tends to work well. The final method that we are going to talk through is called the payback method. The big advantage of the payback method is it's very simple to explain. The concept is straightforward. What we do is we look at the investment and then figure out how many years without consideration for present value, right? Without consideration for time value of money. How soon do we recover our money back? So in this example, you're buying an investment of making an investment of $300,000. The cash inflows are 100,000 in year one, 120,000 in year two. So by the end of first year, you recovered 100,000. By the end of second year, you recovered 220,000. And then the cash flow in the third year is 80,000. So by the time you're done with year three, you have recovered all the $300,000 you have invested. Again, remember, we are not making no adjustment for time value of money. But if we ignore the time value of money, what we see is by year three, we have generated profits of 300,000 to offset the initial investment of 300,000. So in the payback method, all you're going to see is how soon. The only question is how soon does it take for us to collect our money back? It's a very risk-oriented kind of thinking. It's trying to protect your capital. So you're trying to figure out, hey, how quickly can I get my money back is the essential question that's being asked here. The interesting thing to note is that even though this was a 7-year project and there are future cash flows that happen in year 4 through 7, from a payback period calculation standpoint, that doesn't matter. We are only interested to the time point where we recover our original investment. So it's all about how long it takes to recover the initial investment. Of course, the great thing about the payback method is extremely simple to calculate and communicate. In fact, a lot of people think in those terms. How soon can I get my money back? Right? It's highly focused on liquidity because the sooner you get your money back, the more liquid you are, and it focuses on managing short-term risk because the sooner you get your money back, the less likely things can go wrong. And it's particularly valuable for companies with capital constraint. If you are making losses for a while and you are looking to minimize your cash outflows, you're close to bankruptcy, say. So in those circumstances, a payback method may be a perfectly good method to use. But like we said a minute ago, it ignores the time value of money. It arbitrarily cuts off the cash flows beyond the payback period. It doesn't care about what happens after. And if it turns out this was a project where most of the value was in the later periods, it will, it'll reject this project or prefer a project which may be less valuable and recovers its money sooner compared to a truly high value project, just because the high value project has a longer time horizon to recover its investment. Okay, so just to recap, the NPV is the theoretically most reliable method. It focuses on value creation, how much the benefits exceed the cost in present value terms, and it's the most theoretically reliable method. The IRR is intuitively appealing. Everybody loves to talk in terms of percentages and returns, and so IRR allows that, but we have to think a little bit carefully about the types of cash flows and the circumstances in which we are employing the IRR, but it has appeal from a presentation standpoint, especially to leadership. Payback, simple method, very valuable when uncertainty is high or cash flow is tight. It can be thought of as the risk check, perhaps not in fact, it's probably the least theoretically sound method, but it is still a method that should be in your toolkit and to be used in very specific circumstances. I think that would cover all of the topics I wanted to discuss in this video. Hopefully, the logic and the concepts are apparent to you, and you feel comfortable using a particular problem's data and plugging it into a chatbot to be able to compute the NPV, the IRR, and the payback periods. But as always, if you start doing that and you run into any issues, please feel free to reach out. We are here to make sure that you feel confident in applying these techniques in your work circumstances. Thank you for your time. Looking forward to seeing you at the next video.